Let's start with a nightmare. Imagine you buy a house. You pay, sign the contract, pop the champagne. And 3 days later, you find out the house still technically belongs to the seller because the paperwork hasn't settled yet. Welcome to the world of finance, where moving money and ownership takes time, lawyers, and entire institutions just to make sure that when you give someone cash, you really get what you paid for. Now picture a world where that exchange happens instantly, with no middle steps. You hand over digital cash, ownership flips automatically, and everyone's ledgers update at the same second. That idea, making ownership move at the speed of the internet, is what tokenization is all about. Part 1. What on earth is tokenization? Let's kill the buzzwords first. Tokenization does not mean turning your life into a video game. It simply means representing something you own. A share, a bond, a dollar, maybe even a piece of real estate. As a digital token on a shared computer network that can enforce the rules automatically. Think of today's system as an Excel file locked inside a bank's basement. You can't see it. And every time ownership changes, a clerk somewhere updates a cell. Tokenization moves that Excel file to a shared, programmable environment where ownership changes by code, not by clerks. It's like the difference between emailing a scanned signature versus using DocuSign. Both are digital, but one is dumb data, and the other actually does something. Part 2. Why is everyone suddenly excited about it? Because big names finally joined the game. BlackRock, the world's largest asset manager, launched a fund whose shares live on a public blockchain. Franklin Templeton did something similar. JPMorgan used tokenized fund shares as collateral in real trades. Governments are experimenting too. Hong Kong issued digital green bonds, Singapore is running pilots, and central banks are exploring a unified ledger where digital money and digital assets move together. In other words, the lab coats are off and the suits have walked in. Part 3. Why does this matter? Finance, at its core, is about trust and timing. When you trade something, 2 risks appear. 1, you deliver, but the other side doesn't. 2, you wait days before anything becomes final. Tokenization promises atomic settlement, meaning either both sides happen or nothing does. Instantly. No dangling risk, no waiting until Tuesday for a confirmation email. That sounds small, but imagine how much capital sits idle today just to cushion those delays. Every hour you shave off settlement saves collateral, fees, and human sanity. Part 4. The economics behind it. But in human language, economists have fancy names for the reasons this could work better. Let's translate a few. First, transaction costs. Every trade today passes through layers: broker, exchange, clearinghouse, custodian, central bank. Each layer checks and reconciles the same data. Tokenization says, let's agree on one shared version of truth, so we don't all do the same work twice. Fewer middlemen, fewer fees. Second, settlement risk. In 1974, a bank in Germany collapsed mid-trade, leaving partners unpaid, a famous Herstatt risk. Tokenization removes that gap in time. Either both sides complete or both revert. It's the financial equivalent of an elevator that refuses to move until the doors are closed. Third, network effects. Markets thrive where buyers and sellers meet. If each institution builds its own private blockchain, liquidity fragments. The real win comes when everyone agrees on common standards. One playground instead of 20 fenced yards. Fourth, singleness of money. A dollar should be a dollar everywhere. Tokenization works only if the money used to settle trades is itself trustworthy, either central bank money or regulated bank deposits. Otherwise, you get chaos. Different digital dollars worth slightly different amounts. Not good. Part 5. Okay, but what does this look like in practice? Picture a big corporate bond. Today it lives in a regulated warehouse, a central securities depository. When you buy it, instructions fly through several systems before ownership officially changes. In a tokenized setup, that bond is represented by a token on a shared ledger. You send digital dollars from your wallet to mine, The moment that happens, the code transfers the bond token to you. Done. Settlement complete. You can even program the bond to pay interest automatically every month, like a self-driving paycheck. It's the same financial logic, just stripped of the paper cuts. Part 6. Sounds perfect. What's the catch? Plenty. If assets live on different blockchains that don't talk to each other, you get fragmented liquidity, islands that can't trade. If a smart contract glitches, who's legally responsible? Code doesn't show up in court. And if trading becomes fully transparent, privacy and market manipulation risks appear in new forms. Finally, regulators insist on one golden rule. A tokenized security is still a security. Compliance doesn't disappear just because the spreadsheet got cooler. So the technology may simplify plumbing, but not the legal or ethical headaches. Part 7. The early winners and lessons. The first real success story is collateral mobility. JPMorgan moved tokenized money market fund shares between parties as collateral in minutes, not days. That saves banks millions in margin costs. BlackRock's fund is already being used in similar ways. Governments use tokenization to issue bonds faster and test multi-currency settlement. These are not sci-fi experiments. They're dress rehearsals for a financial system that never sleeps. Part 8. The bigger picture. If this works, we move from batch processing, T+1 settlement, to real-time finance. Capital markets could become 24/7. Collateral could flow automatically where it's needed. Banks might issue tokenized deposits. Central banks could provide digital reserves directly usable on the same platform. Exchanges and clearinghouses would evolve from warehouses into orchestras, coordinating code instead of paper. That's the quiet revolution here. Less spectacle, more plumbing. But plumbing determines everything. When it breaks, the whole building floods. Part 9. The takeaway. Tokenization isn't valuable because it's trendy or crypto-ish. It's valuable if it removes friction, if it makes markets cheaper, faster, and safer without breaking the rules. Think of it like upgrading from landlines to the internet. At first, people laughed. Why would I email when I can fax? Then suddenly, no one remembered what a fax was. That's where finance might be heading, from paperwork and waiting to instant programmable ownership. So next time you hear someone say tokenized assets, don't imagine gambling coins or cartoon monkeys. Imagine a smoother global engine, one where money and ownership move together in perfect sync at the speed of trust. That's tokenization. Less hype, more substance. The boring revolution that might just make finance finally feel modern. And if you want more finance explained without the boring jargon, hit like, hit subscribe, and we'll keep breaking down billion USD moves into plain English.